Look at your screen. Look at the numbers flashing in green and red. They tell you a story of stability, of soft landings, and manageable growth. But behind the digital curtain of Wall Street, a silent, rhythmic ticking is growing louder. It is the sound of a countdown. As of early 2026, the United States national debt has roared past $36 trillion, a number so vast it ceases to be math and becomes a weapon of mass destruction. We are no longer talking about a budget deficit or a political talking point. We are witnessing the terminal phase of the largest Ponzi scheme in human history. The U.S. Treasury market, once the risk-free bedrock of the global empire, is beginning to fracture. Liquidity is evaporating. The buyers are vanishing. While the mainstream media distracts you with partisan theater, the plumbing of the world's financial system is hemorrhaging. The $36 trillion debt bomb isn't just coming, it's already been detonated. You just haven't felt the shockwave yet. To understand the horror of the $36 trillion debt bomb, you have to stop thinking of money as a store of value and start seeing it as a leash. For decades, the U.S. Treasury was the ultimate safe haven, the gold standard of paper. But that safety was built on a lie, the assumption that there would always be a greater fool to buy the debt. Today, that fool has left the room. China and Japan, the two largest foreign creditors, have been aggressively dumping their treasury holdings, offloading hundreds of billions to protect their own collapsing currencies. At the same time, the interest payments on this mountain of debt have surpassed $1.1 trillion annually, more than the entire U.S. defense budget. We have reached the event horizon of fiscal math, where the government must borrow money just to pay the interest on the money it already borrowed. This is the definition of a death spiral. The engine of the empire is stalling, and the pilots are frantically printing more paper to fix a problem caused by paper. The numbers have shifted from alarming to impossible. As of late January 2026, the national debt hasn't just crossed the line, it has obliterated it, standing at a staggering $38.4 trillion. We are adding over $8 billion to that pile every single day. That's $92,000 of new debt every second. Think about the speed of your own heartbeat. In the time it takes for one pulse, the engine of the state has borrowed more than most Americans earn in a year. The risk-free facade of the U.S. Treasury is rotting from the inside out because the math no longer works. Net interest payments are now the fastest-growing expense in the entire federal budget, consuming over 22% of all tax revenue. This is a cannibalistic economy. We are at the point where the government is effectively strip-mining the future just to keep the lights on today. The Treasury is no longer a vault, it's a furnace, and your purchasing power is the fuel. The crack in the foundation appeared where few were looking, the Treasury auctions. Historically, these were boring, routine affairs, but by late January 2026, the atmosphere has turned cold. Recent 20-year and 30-year bond auctions have shown weak demand, with foreign governments, the traditional backbone of U.S. credit, taking their lowest shares in years. When the indirect bidders walk away, the primary dealers are forced to swallow the surplus, clogging the balance sheets of the big banks. This is why the 10-year yield has spiked toward 4.30%, its highest level since the chaos of late 2025. The market is demanding a credibility tax. For the first time in generations, investors are looking at a U.S. Treasury note and seeing risk instead of refuge. The yield curve, which was inverted for a record-breaking period, has now disinverted with a vengeance, the 2-10 spread widening to nearly 70 basis points. In financial history, this is not a sign of recovery. It is the final flare sent up before the ship goes under. The soft landing was a myth. We are currently in the vertical drop. While the elites in Davos toast to resilience, the street reality tells a darker tale. This is the era of the shadow inflation. The official CPI figures are a sanitized lie, a statistical sleight of hand designed to prevent a revolution. They tell you inflation is cooling, yet a single bag of groceries costs 40% more than it did 3 years ago. This is shrinkflation as a national policy. You are paying more for less, a literal evaporation of your labor. In early 2026, the average American family is spending $13,000 more per year just to maintain the same standard of living they had in 2021. Real unemployment, when accounting for those who have simply given up on the rigged system, is double the official headline rate. Retail giants are shuttering thousands of locations, and credit card delinquencies have hit a 15-year high. People aren't just struggling, they are being systematically liquidated. The debt bomb isn't just an abstract number on a screen, it is the hungry ghost eating your dinner and stealing your children's inheritance. History is a graveyard of empires that thought they were too big to fail, and the path to the $36 trillion abyss is paved with the same arrogance that destroyed Rome. In its final days, Rome didn't just fall, it debased its currency, the denarius, until the silver content was virtually zero, a slow-motion suicide to fund endless wars and a bloated bureaucracy. Today, we have replaced the silver clipping with the digital printing press. We are repeating the nightmare of the Weimar Republic, where the gap between the official value of paper and the reality of the market became a chasm of despair. Look at the smart money. While the public is fed a steady diet of buy the dip propaganda, the ultra-wealthy are quietly exiting the system. Tech billionaires and hedge fund titans are offloading billions in stock, converting their paper wealth into hard assets, sprawling farmland, private bunkers, and massive hoards of physical gold. They aren't preparing for a correction, they are preparing for a collapse. They know that when the debt bomb finally detonates, the only things left standing will be the things you can touch. The real horror isn't just the debt you can see, it's the debt they've hidden in the shadows. Beyond the $36 trillion headline figure lies a terrifying underworld of unfunded liabilities, promises made for Social Security and Medicare that the state has no way to keep. In early 2026, the real gap is estimated at over $210 trillion. It is a mathematical impossibility. This is the fiscal gap, the silent killer of the American dream. To bridge this void, the government would have to tax every citizen at a rate of 80% or print the currency into oblivion. They've chosen the latter. This is why the Federal Reserve has been forced into stealth QE, injecting liquidity into the repo markets to prevent a total seizure of the banking system. While they tell you the balance sheet is shrinking, the reality is a desperate, hidden bailout of a system that is fundamentally insolvent. The banks aren't lending to you because they are busy trying to stay alive, clutching on to devalued treasuries like anchors in a storm. The world has finally grown tired of subsidizing the American nightmare. For 80 years, the US dollar reigned supreme because of a blood oath called the Petrodollar, a deal where the world bought oil in dollars and the dollars flowed back into US treasuries. That deal is dead. In early 2026, the BRICS Plus alliance has expanded its reach, with Saudi Arabia and the UAE now settling massive energy contracts in yuan and local currencies. The unit, the new BRICS common currency backed by gold and a basket of commodities, is no longer a theory, it is a functioning settlement system that bypasses SWIFT entirely. As the world stops needing dollars to buy energy, those trillions of euro dollars parked overseas are beginning to flood back home. This is the Great Reflow. When those dollars return to U.S. shores, they won't bring wealth. They will bring a tsunami of hyperinflation that will make the 1970s look like a golden age of stability. The walls are closing in, and the dollar's exorbitant privilege has become an exorbitant liability.
While you watch the ticker tape, a secondary explosion is occurring in the dark corners of the financial system. The derivatives monster. As of 2026, the notional value of the global derivatives market is estimated at over $1 quadrillion. To visualize that, if every dollar of global GDP was a single inch, $1 quadrillion would reach past the orbit of Saturn. These are complex bets, credit default swaps and interest rate hedges, tethered directly to the stability of the U.S. Treasury. But as bond yields become volatile and unpredictable, these hedges are turning into financial landmines. When the Treasury market stopped during the liquidity dry-up of late 2025, it triggered a chain reaction of margin calls that the public was never told about. The big banks are currently sitting on a mountain of unrealized losses that make the 2008 Lehman Brothers collapse look like a rounding error. They are insolvent in all but name, kept on life support by a Federal Reserve that is running out of blood to transfuse. As the $36 trillion bomb prepares to detonate, the global architect has already revealed the fallback plan, the CBDC. This is the digital gulag hidden behind the mask of convenience. In early 2026, the Federal Reserve's FedNow system has evolved from a payment rail into a precursor for a programmable US dollar. This isn't just digital money, it is a tool for total behavioral control. Imagine a currency that expires if you don't spend it fast enough to stimulate the economy, or a balance that shrinks if your carbon footprint is too high. The elites know the current debt-based system is terminal, so they are building a digital cage to transition the survivors into. They will offer it as a solution to the very chaos they created, promising stability and universal basic income in exchange for the total surrender of your financial privacy. In the financial horror of the near future, your bank account won't be a record of your work, it will be a social credit score you can't afford to lose. The final crack in the dam is the commercial real estate apocalypse. As of 2026, the $20 trillion sector is no longer just in trouble, it is a wasteland of zombie assets. With office vacancy rates in major hubs like San Francisco and New York hovering at a permanent 30%, the underlying valuations have cratered by nearly half. But the banks haven't marked these assets to market yet. They are carrying these loans on their books at 2021 prices, praying for a miracle that isn't coming. In early 2026, a $2 trillion wall of CRE debt is coming due for refinancing at interest rates that are double or triple the original terms. Small and regional banks, which hold nearly 70% of this exposure, are facing a Minsky moment. When these defaults hit, they won't just take down property developers, they will shred the collateral that backs your local bank's solvency. This is the shadow banking explosion, a hidden fuse connected directly to the $36 trillion core. While the system fractures, the world's central banks are engaging in the most significant financial gold rush in human history. They are telling you to stay in the stock market while they are buying the exit. In early 2026, global central bank gold buying has reached a 70-year high for the third consecutive year. Countries like Poland, China, and India aren't just buying gold, they are bringing it home, demanding physical delivery from the vaults of London and New York. This is a vote of no confidence in the very system they manage. They know that when the $36 trillion debt bomb finally renders the U.S. Treasury market illiquid, the only risk-free asset will be the only thing that doesn't have a counterparty. At the same time, we see the rise of the digital gold narrative being co-opted. Institutional giants like BlackRock have swallowed nearly 5% of the total Bitcoin supply. The message is clear: the bridge to the old world is burning. The elites are building rafts out of hard assets, leaving the masses to drown in a sea of devalued paper and broken promises.
The day the U.S. Treasury market stopped wasn't a sudden explosion, but a chilling silence. In the final weeks of 2025 and moving into 2026, the bid-ask spread, the gap between what sellers want and what buyers will pay, widened to levels seen only in the darkest hours of the 2008 crash. The primary dealers, the megabanks mandated to keep the market moving, simply stepped back. They couldn't handle the volatility. For several terrifying minutes during a Tuesday afternoon session, there were no buyers for the 10-year note. The heart of global finance skipped a beat. This is the liquidity black hole. When the most liquid asset on Earth becomes illiquid, everything else, your 401k, your insurance policy, the value of your home, becomes a theoretical number you can't actually touch. The Federal Reserve was forced to intervene with an emergency standing repo facility, pumping hundreds of billions in overnight band-aids just to prevent a total systemic seizure. They didn't fix the leak, they just bought a few more hours of borrowed time. The $36 trillion debt bomb is not a math problem to be solved, it is a destiny to be fulfilled. As we move deeper into 2026, the illusion of recovery has been replaced by the cold reality of managed decline. The day the Treasury market stopped was the final warning shot across the bow of the Titanic. You are living through the Great Devaluation, a period where the government will sacrifice your purchasing power, your privacy, and your freedom to keep the machinery of the state from seizing up. They will tell you that stability requires your compliance, that solidarity requires your poverty, and that safety requires your digital enslavement. But the truth is simpler. The debt is a fire that has run out of wood, and it is now beginning to consume the house itself. You cannot fix a system built on the theft of the future. You can only survive its conclusion. Watch the yields, watch the gold, watch the exits, because when the bomb finally levels the field, the only thing that will matter is what you held when the music stopped.